What is going on today, YouTube? Today we're going to talk about stock and bond allocation, what people are talking about, and why people say you should do it. First of all, real quick, stocks, we're going to look at just two Vanguard. We're going to look at Vanguard Total Bond Market Index Fund, which is VBMFX, and we're going to look at Vanguard Total Stock Market Index Fund, VTSX. We're looking at their max charts for as long as they've been around, or for as long as they've been tracked. So I'm sure you notice a difference already. To make this easy, we're going to go from the beginning of 2009, because this is the end of 2008, this is the end of 2009. So beginning of 2009, we're going to get this candle right here, we're going to go up to today's value. So right here. So stocks have went up 262%. And the total stock market index, Vanguard Fund. Now we're going to look at the bond, total bond market index fund. Same spot. So at 2008, we are going to go from right here. Bonds have went up 2%. So right there, you see the biggest difference, 200 and some percent to 2%. If you are brand new to this stuff, you're probably thinking, why in the world would I ever invest in bonds if over 10-year span they went up 2%, where the total stock market went up 260%, give or take. Easiest way I can put this, when you're young, you're not really worried about price, you're not really worried about anything. If you're starting as a young investor, you want to make as much money as possible. So a lot of financial advisors or stock market people out there will say you want to have your biggest allocation in stocks because you can go through a lot of fluctuation. It's not going to matter if you're in it for the long term. We're only looking at a 10-year span. I mean, I'm talking if you're in for 30 years or so. But you're not really worried about preserving your money when you're young. You're just worried about making the most out of it. So investing in bonds is more of a play when you're getting closer and closer to retirement, because this can't fluctuate as much. No, you're not going to get the returns you want in the stock market, but say we're on the reverse side and the stock market was falling and bond markets fell, say they usually go inverse of each other, but sometimes they can go hand in hand. So if you have less money in stocks and a lot more money in bonds, you don't have to worry about that price fluctuation as much. And some people say put 90% in stocks and 10% in bonds, or 75% in stocks, 25% in bonds, and then just reallocate as you need to. And an easy way to do this, all this reallocation means is, so say it's typical, bonds are going to go up, stocks are going to fall. So the bonds go up, you're going to have more money in bonds than your 25%. Say you're holding yourself to 75%, 25%. You're going to have more, bonds go up, you have more money in your bonds. So now you might have a 70% in stocks and a 30% in bonds. But bonds are going up and the stock market's falling. So you want to readjust your whole portfolio at that time. So you're going to take out the 5% gain you had in bonds and buy more stock with that. And you're going to buy, again, Vanguard Total Stock Market. You're going to stay in the same thing. But you're going to, if the stock market's falling, you're going to buy their stocks at a lower price. And if you reallocate every single year and you try to keep that 75-25% balance, technically, if you're in retirement, you won't make out on all the gains if you had 100% in stocks, but you're not going to lose all your money if you have a nice little bond. The stock versus bond difference was 100 times, 2% versus 200%. So if you go through this rebalancing act, every time the stock market goes down, you're going to buy more and more stocks, and then you're going to decrease your bonds, and then vice versa. If the stock market's going up like crazy, and then you're going to have, instead of having 75% in stocks, you have 80% in stocks and 20% in bonds. And this is a really, really conservative. But say now you're up to 80% in stocks, 20% in bonds. If you transfer over some of those gains you received in their stocks and transfer them over to bonds, your money is safer in those bonds. Because like you saw, the price will not fluctuate that much. And then you are, in a sense, preserving your money in bonds. So you're always going to keep around that same amount of wealth you have, even though you are withdrawing from it every single year. You readjust your portfolio to get that 75-25 or 90-10, whichever percentage you want to keep inside your retirement account. And this is what And this is exactly what everyone's talking about when they say 75-25. They're not talking about every single day. Like you watch the stock market, it goes up, and you're like, oh my God, my stock percentage is up to 80% and my bond percentage is down to 20. No, you do this at most twice a year or at most every quarter, so 4 times a year. But a lot of people just do it 1 time a year and then they just let it go and let it be. They don't even worry about it. The whole idea is not to have a stressful life when you're pulling the money out of your investments. It's all about what is the least amount of work I can do to readjust 1 time a year, or you could. I'm sure there's many people out there that even pay people to do this, but they readjust their portfolio once a year, and they keep on redrawing, or they keep on drawing out of it at a modest rate, and they live their life like they want to. So that's it for the video. I just want to talk about stock bond allocation, what it is, and why people do it. So if you have any questions on the video, leave a comment below. If you like the video, leave a like on it. And if you like the videos like this, subscribe to my channel, and I will see you in the next one.